I'll call the meeting to order for the Public Works Retirement Board. I'll start off by taking roll call. Matt Doobie.
Here.
Matthew Gregg is not here at this moment. Don Enright is out this week, I believe. Terry Harris.
Here.
Dan Hudson.
Here.
Alderman O'Brien is not available today. Myself, Dave Fredette. And of course, we have Mary. We have Eric from, I always forget the name of your company. RBC, and we have the mayor in the back here. I'm sorry, but I'm still kind of new back on this, so I forget. Now, you're going to do something a little later, right?
Yes.
All right. The first item on the agenda is accept the minutes of the December 30th, 2024 meeting. Is there a motion?
Motion to accept?
Second?
Accept.
Okay. Any discussion? If not, all those in favor say aye.
Aye.
Okay, next item.
I'm going to abstain because I wasn't at the meeting.
You weren't at the meeting?
Yeah.
Okay. That's true. Next item on the agenda is a retirement, William J. Toomey. As you know, we've had some issues with that because he passed away just a few days before the retirement. And I had a meeting with Attorney Bolton on our concerns, and I've also talked to our attorney in Manchester, who is the pension attorney, and they're both looking into it and seeing if there's something that can be done to solve the issue. But right now, I think the best thing is to vote to approve the retirement of Bill Toomey. We haven't done that yet. So is there a motion for that?
Motion to approve.
Okay.
Bill Toomey.
Is there a second?
I'll second that.
All right. Any discussion on it? If not, all those in favor say aye.
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 And those opposed? And again, as things change on this, I will let everybody know, make sure everybody knows what's going on. It's unfortunate that he passed away just a few days before his retirement, so. Next thing is old business. We have update ordinance changes for the IRS. That's in the works. That's John in Manchester. RFP for trustee of trust fund services. That is also in the works. And Hooker and Holcomb pension training, which, Dan, I think you've been, Greg really's been, which one, Greg or you?
Yeah, it's been Matty Gregg is the one that's taking the lead on it. The idea is that we would provide some training to staff well in advance of their retirement or pending retirement, just as an educational thing. So Matty Gregg is taking the lead on that. I think he's reached out and has some ideas, so I think we should defer that till he's back and can speak to it.
Okay. And I had forgot to list something under old business, but it was last month we got that letter from Travelers Insurance, and I did talk to Risk Management, and that should have went to them and not to Public Works. It is a fund that, an insurance policy they've had for years for the pension program. So it unfortunately just came here by mistake. So that's all set. And the premium on that is due in July, so they have that on their list. New business is the approval of distribution of funds for the period of September 1st, 2024 through September 30th, 2024. I'll give you a minute to look at it if you haven't. Are there any discussions on that?
No, I would move to approve the distribution of funds for the period of September 1, 2024 through September 30th, 2024.
Okay,
I second.
second. Any discussion? If not, all those in favor say aye.
Aye.
Opposed, and that motion carries. If you look at the top of that sheet where it says the disbursements over the years, fiscal years, I think I mentioned this before, but you can see fiscal year 20 was 3.2 million, this year, fiscal year '24, is 4.2 million. So the disbursements keep growing. Benefit payments, it's mostly the benefits payment, there's a few other reasons, but that's most of it. Let's see. Approval of the USI invoice for pension administration services to December 31st, 2024, for an amount of $10,350. Any discussion on it, or? I know that's more of a routine thing also.
It appears to me to be in order. I would move for approval of the USI invoice for services through 12/31/24.
Moved by Dan, seconded by,
I second.
okay, by Terry. Any other discussion? If not, all those in favor say aye.
Aye.
Opposed, and that motion carries. Annual pension, oh yeah, annual pension statement, mail-in discussion. I'm still a little, we were given the statements for each employee. And I guess USI can mail those out. But I think the discussion was, should we do that instead? That it might cost less, but we'd have to have someone do that. That used to be done out of the treasurer's office, so I'm not sure.
I think, did you do that mailing last year, Mary?
No, we had
Okay.
USI.
Oh, we did, okay.
Do we know what they charged? Because I don't know.
Not off the top of my head.
I mean,
Well,
yeah, I mean, my opinion would be that it's something that we should do. We should mail members an annual statement, so, it's, I forget how many members we have, but I wanna say the mailing last year was about $1,000, if my recollection is correct. Maybe 1,000, 1,100,
well,
something
why don't I
like that.
find out what the price is from
Yeah.
USI, and I'll let everybody know.
Okay.
And,
Take it up at the next meeting then?
well,
Or do you wanna?
if nobody seems to object on the cost, we'll probably go with them. Is that okay? I'll see. I might have to wait till the next meeting, so.
Okay.
The other area is, I'm sure some of you have heard about the Social Security Fairness Act that passed at the end of the year. Something that's been, I guess, discussed for years and years. Very hard to find out exactly how it all works. I've tried, but it's my understanding that it will help some of our current retirees in public works. How many, I don't know. How much, I don't know that either. But it does, everything I have read is saying it's gonna take over a year before they send out the first checks. And they have to go back through the whole year of 2024. And then people would get them monthly, just like everybody else. So I'm hoping as time goes on, we'll find out more information, but at least from my discussions and what I've read, that will help some of our retirees, definitely.
Yeah, I don't have, I have only anecdotal information, but I have employees that are considering retirement. Their discussions with the Social Security Administration have indicated that, yeah, it will increase their Social Security benefit. So I think what you're saying is correct. So hopefully that is the case.
No, and if they go back a whole year, that'd be a nice little check at least when they get that. Any other questions on that? Before we get to number 6 and 7, we do have RBC Wealth here to give, is this a quarterly or a 6-month?
It's roughly
Quarterly presentation on the investments. Is it okay to start now? I didn't know if you wanted to.
Absolutely.
So before you start, Enrique, there was a WebEx that we moved to Zoom, and Mary
That's
sent out the stuff, so
Yep.
I don't see anybody on yet
No.
from your group. Okay.
But they're aware. So
Okay, that's fine.
they're going to be coming in
Okay, thank you.
that way. Yeah. Yep. So
Eric,
they'll
why
be
don't you,
using your link.
you know,
Sorry, Eric.
tell everybody who you are, because we're more public today,
Mhm.
and, you know, what your position is, and
Mhm.
how long we've had you for investment services, that kind of thing.
Okay. So I'm Eric Stubbs from RBC, Royal Bank of Canada, and with me is Mike Wynn as well. And I think we're both senior vice presidents.
Yes, we
is
both
that
are,
correct?
yes.
Yes.
Just means we're old.
And we've been managing the investment side of the pension plan since 2013. So, yeah,
Wow,
believe it or not.
long.
Yeah, so it's been quite a while now. So as a consequence, we're pretty familiar with the plan, its needs, and of course its history, at least for the last 10 or 12 years. And on top of that, in addition to us, we have a staff of 3 people, one of whom is a specialist in math, which allows us to analyze actuarial reports. We don't write actuarial reports, but we analyze them, and we use the information from the actuarial report to figure out what to do on the investment side. So that's what we've been doing. RBC is a large corporation. It's got somewhere on the order of 8,000 employees in the US, and worldwide about 90,000 employees. And as a result, we're fully staffed in terms of economics capabilities, retirement services capabilities, brokerage capabilities, trading capabilities, everything else that you would need to underpin what we do as a front end on the investment side.
And I remember the RFP process in 2013. We went, the board did a very extensive one, and we originally had 8 companies, and then we went down to 4 and then 2. And I think one of the changes was we used to have 2 companies, and we decided to have 1. It is a lot easier to follow.
Yes.
So we've had that since, and I know you guys done a very good job.
Thank you.
Thank
Yeah.
you. So if you want to start off with your
All right.
presentation.
So for anyone who has it, we have the materials in
Yeah.
a little packet.
Oh, you got it in the packet too?
Yep.
Oh, God. Ooh. It's cold.
Yep. So where I'll ask you to start is there's a short summary piece called the December 31 Performance Summary,
Yeah.
which is 1 page long plus all of the usual disclaimers and disclosures and everything else. So we'll concentrate on the single page, and this gives you a summary of the position of the assets as of December 31st of this year. So the important first number is what's the balance in terms of assets in the pension plan in terms of the investment account. So this does not include other money held by the pension plan, but on the investment account. And December 31st, it was 56,075,000 roughly.
No, I don't remember it being ever that high.
No, I think this is probably a high water mark. In fact, we could go a little further since it's the end of January now, beginning of February. We took a look this morning to see what the value was on Friday, and it was 57,329,000, so up 2.2% for January. Now, the breakdown in terms of assets, and this is, you'll notice there are 2 things on this page, the breakdown by accounts, and below that breakdown by assets. And the reason they're a little bit different is because the accounts have cash in them, and that's a separate category for us. So when you just look at what's actually in the portfolio on the stock side, it was 37.25 million. That was about 66.4% of the assets. The bonds were 17.072 million. That was about 30.5% of the assets. And then there was 1.7 million in cash in addition to that. So that's how it broke down in terms of assets.
And our guidelines is for equity,
Is up to 70%, yeah. So what we did, by the way, last year, as I think everybody knows, was a successful year for equity. So toward the end of the year, we took money out of the stock side into the bond side. So in December, we moved $1 million into the bond side. One, to rebalance, to make sure we were compliant, but the other is from a strategy standpoint. It seemed to us like a good idea to cut back a little on risk right now. So that was the other motivation for doing that. And it's something we'll probably continue through this year to do, is move a little bit more money from the stock side to the bond side as we go. So reviewing performance, we have on this sheet the prior fiscal year performance, because it's always a good idea to keep your eye on what happened most recently and the current fiscal year. So for the prior fiscal year, the one that ended last June, at the end of last June, the pension fund as a whole was up 15.99%, let's call it 16%. For the first 6 months of the current fiscal year, so that was from July 1st to the end of December of 2024, it was up another 5.44%. And for the 12 months, meaning the calendar year of 2024, it was up 14.78%. So those are nice numbers to have in the pension fund, but the question that always comes up is, what should we be comparing that to? So there are a couple of things that one can compare it to. First of all, the assumed discount rate on pension fund, in other words, what you assume you're going to make long-term on the pension fund, is about 7%. So the good news is it's well ahead of that. Then the other thing you can compare it to is a combination of assets. If you ask yourself, if I just took what the guidelines in the pension plan said we should do, how would that have come out in terms of assets? And depending on specifically which one you use, it's somewhere around almost 14% or 12.5%. So the 14.78%, fortunately for the last year, has outperformed the benchmarks as well. Now, one thing that some people use kind of conveniently as shorthand for a pension benchmark is just say, okay, well, tell me what would have happened if it had been 60% stock, 40% bonds, just indexed it and left it alone. That would have been 11.5% for 2024. So the 14.78% nicely outperformed what a 60-40 mix would have given you. In terms of what that means in dollars, to translate that difference in dollars, was an additional $1.8 million that the pensions accrued in terms of assets, just from that difference. So it's worked out for the pension fund. Now, needless to say, when you do something like that, what you're doing is you're managing risk at the same time. Last year, we were fortunate because the risk all went one way, it went upward. So that's not always the case. As we discovered, by the way, in 2022, when both stocks and bonds fell. So part of our job is to try to look at the economic indicators and try to make an assessment for where the risks lie and get the fund out of the way of those risks to the best of our ability. So we want to stay compliant with the guidelines, but we want to tilt it toward taking less risk when the environment is more risky, taking more risk when it's a positive environment, which is what we've been doing over time. So to give you a real life example, what does that mean today? What it means, for instance, is as we take money out of the stock side, probably put it in cash-like instruments on the bond side, because they're earning pretty well without taking too much risk on the interest rate standpoint. Where you look at the stocks themselves, what it means, for example, is maybe what we do is reduce tech to some extent, because that's been a high flyer for 2 years, and put some money instead in financials, which, because of where the yield curve is right now, financials have been doing pretty well. Chances are that they may continue to do well in 2025. So we want to reduce the risk on the tech side and use that money to put some money into financials. So that gives you a little bit of the summary. I'm going to go into a few details from another document. But at this point, are there any questions, any comments?
No, it's just that I know, because of all the good works you've done over the years, our funding level for the pension fund has been very high too, which I know some people might read about in New Hampshire, the state pension
Yes,
has had
right.
trouble for years. I think ours is at least in the mid-80s. Sometimes I know it's reached 90.
I think it's pretty close to 90 now.
Yeah,
Yeah.
so that's also a very positive.
Your actuaries are about to come out with a report, which literally should be any day now. And so it'll give you the figures, but our guess, doing the math ourselves, which is not official math, but
Mhm.
we try to keep up with it, is that I'd be somewhere close to 90.
That's good. Very good to
Yeah.
hear. All right, any questions, or we should go, okay, we
Okay.
can move on?
So I'm going to ask you to look at the portfolio review for a moment, which is a little bit longer performance document. And I'm just going to take you through a few pages on this that I think are important. The first one is page 4. And what page 4 gives you is a little bit of a history in terms of the cash flows in the plan. And I focus normally on the 5-year numbers because on a year-to-year basis, markets go up, markets
Right.
go down, and there's a lot of volatility in them. By the time you're looking at the 5-year numbers, you're kind of getting more of an average and an aggregate over time. So if you look at the 5-year total numbers toward the bottom of page 4, 5 years ago, the plan started with the year with 44 million in it. From that point to now, 8.4 million came out in terms of benefit payments. In the meantime, over those 5 years, the assets made just a shade over 20 million. So that's how you get to the 56 million now. So that's been the experience of the plan. If you look at page 5,
The adjusted net cash flow.
Yep.
That's money going out for the pensions themselves, basically.
money going out
Okay,
minus whatever money came in.
yeah.
Page 5 tells you a little bit about the asset allocation. And here, apart from what we've already talked about, I think the most significant thing to notice here is about halfway down the little table on the right-hand side, you've got international equity, and before that's small cap equity. International equity is at the low end of what the guidelines for the pension plan allow, and the same is true for small cap equity. That's deliberate. And if you recall the last year, and actually the last several years, international equity has not done very well compared to US equity. So what we tried to do is, over the last 5 years, not just last year, kind of minimize the amount we have exposed to international equity. It's something we're probably going to continue doing in 2025 for a variety of reasons, including tariff issues and a variety of other things as well. Likewise, small cap. With small cap, that's one of these areas where hope springs eternal, but it just has not kept up with large cap stocks in the last several years. So that's been something that we've also minimized going forward. And we'll probably continue to minimize for this year as well. I'm going to jump ahead to page 13. A lot of what this longer presentation covers, we've already covered, so I'm not going to repeat those pages. So page 13 tells you a little bit about the sector allocation. In other words, within the U.S. markets, which sectors have we emphasized or de-emphasized? And the thing that's always striking when you look at these graphs is the information technology line is way bigger than any of the other lines. And the exposure to information technology is about 31% of the stock exposure. Now that sounds like a lot. It's actually slightly less than the S&P, believe it or not. And the financials here at 13.7% of the stock exposure is about where the S&P is. And what, as I said, we'll probably end up doing is increasing that a little bit as we go forward. Can you take a break? Would you mind giving a look at that?
Yep, I'll be glad.
Page 14 tells you a little bit about the bond side, which we haven't talked about yet. And so it's worth, I think, spending a moment on the bond side. So on page 14,
Do you already have that copy?
there are two important things, I think, to take away from this. The first one is virtually everything is investment grade. In fact, 3/4 of it is U.S. Treasuries and agencies and CDs. So in terms of credit quality, what's in the pension plan is at the extreme high end of credit quality on the bond side. The second thing to notice is the maturity distribution. If we had looked at this graph some time ago, what we would have seen, pardon me, let me just turn this off. What we would have seen is that about 50% of the funds were in short-term money. And the reason we did that a few years ago was because the Fed was raising rates. And when the Fed is raising rates, you don't want to be out the yield curve because you're going to lose money doing that. So we kept more cash at that point. Since then, when it looked like maybe the Fed was going to lower rates, we extended out the maturities. So rather than having 50, 60% of the money in basically cash or cash-like instruments, now you've got less than 30% in short-term cash instruments, and the rest of it is in 3 to 10-year bonds, which is kind of more conventional for what you do in a pension plan, because most of your actual liabilities, your costs, are 3 years, 5 years, 10 years, 20 years in the future. So this is a little more conventional in terms of what happens with pension funds. Page 15 tells you a little bit about the income that all these bonds are generating, and it's about 1.1 million a year. So that's the yield that's coming off the bonds. So I'm going to stop at this point. That gives you the highlights, and maybe a little more than the highlights, for where the pension assets are at the moment. And I'll stop in case there are any questions or comments.
Any questions?
Yeah, we're gonna hear more about 25.
About 25, that's the next on the agenda. So we're fortunate to have with us Kelly Bogdanova, who's on the screen there. And I asked her, she's one of our very excellent analysts and strategists in wealth management at RBC. She's a vice president and portfolio analyst at RBC. And what I asked her to do was give us a little briefing on her views for what 2025 might hold for us. So Kelly, if I may, I'd like to turn it over to you. You're on mute right now. Here we go.
Very good. Thank you very much. It's a pleasure to be with you. Eric, our colleague Jackie Khanna, I just forwarded him my presentation. And Jackie, I'm wondering if you can put it up on the screen for me, and if I can just guide you through the slides, if you wouldn't mind doing that.
Yes. Let me see.
As a backup, Kelly, I think everybody has a copy of the presentation, so if we have to go with old-fashioned paper, we can do that.
Very good. While Jackie's doing that, why don't I just start off, since you do have the copy in front of you. Jackie, when I start speaking, I'll be speaking to slide 7 to start off with. But what I want to do is give you a sense as to how we're seeing the market right now, basically our outlook for the year. And I'll also discuss how the changed configure in Washington plays into this. I do have a number of slides at the beginning of the presentation that review some 2024 returns of the market overall, and does give you some more detail as to what Eric was talking about, which is how different parts of the market impact at different times. And last year it was definitely impacted a lot by a narrow group of tech stocks. So I encourage you to look over those slides because I think it will provide some background, but I want to focus on this year. And, when it comes to the market, our main message is that we do have a more complex and dynamic investment environment this year than we had last year. And so our key message on this slide that you're seeing here, hopefully on slide 7, if you're following along in the paper, is that we're encouraging investors to be nimble with portfolio allocations and to look beyond the horizon for opportunities. And what I mean by that is we're all long-term investors. So our focus should be not only for this year, certainly important to talk about this year, but to talk about the longer term as well. The next slide, Jackie, if you wouldn't mind going to that, it shows our economists' GDP forecasts for the US, for global, and other major economies. The forecast as it stands now is 2.6% GDP growth. Give you some context, that would be above average, slightly above average growth. That would be pretty good growth if it ends up panning out. Globally, 3.8%. A couple of things to notice about other countries that I've got up here. The Canada forecast is for 1.8%. But if the tariffs that were announced yesterday are implemented, and if they are kept in place over a number of months, even throughout this year and throughout next year, that would be recessionary for Canada. So these are estimates that were given right before the tariff news hit. For China, the estimate is 5%, and that's typically what the China economy has been doing in the past couple of years. The reason I bring up China is because that's a major contributor to global growth. So with all of this in mind, on the next slide, here's how we're thinking about this year for the United States, which is what we are most concerned about. We do expect that GDP growth to be somewhat slower than it has in recent quarters, but it's a good pace nonetheless. Now, with that said, we have had a leadership change in Washington, and normally risks associated with Washington policy do not tend to drive markets over the longer term. And I'll explain more about that, what I mean about that in a little bit. But even though that's the case, that there are other factors that typically play much greater roles in shaping investment returns, markets and investors will be paying much closer attention to Washington. And policy risks associated with decisions could generate volatility. And we're already seeing this morning with the tariff news that came over the weekends. Markets have pulled back on that globally. So when it comes to our overall outlook for 2025, we are constructive about the potential for the stock market to give us gains, but we're vigilant because there are a few risks associated with the market right now. And we do expect more bond market volatility. And in fact, we have seen tremendous bond market volatility over the past couple of years. So the next slide, let's focus a little bit more on GDP growth, the growth that we expect for our economy. What I'm showing you here in dark blue is the actual growth rates that the US economy has had in the recent years. What is in light blue are the consensus forecasts from economists. And all that means is just the aggregate forecasts of all economists on Wall Street averaged together. So you can see the light blue is still showing nice growth, but this emphasizes a point I just made, which we're expecting less growth than we saw in example in Q2 and Q3 of 2024. So a bit of slowing, but if this were to pan out, this would not be troublesome for the market at all. On to the next slide. This gives you a perspective of the S&P 500. So often when we talk about the market, we're talking about this particular index. And this index has done quite well since 2019. Since that time, it is up 141%. and that is not including dividends. And if you just look at what we call the current bull market rally, that bull market rally is highlighted in red, and that began in October 2022, and the market is up almost 70% since then. So it's really been a great run in the last couple of years. And even if you look back and considering the severe pullback we had during the COVID crisis, the market has done quite well since 2019. So the question is, does this bull market have the potential to extend for longer? And we do believe that it does. The signs that tend to point to the end of a bull market rally are not yet visible. And what I mean by that is typically when the bull market is coming to an end, two things normally happen. Number one, the attitude of investors tends to get extremely positive. This might sound counterintuitive, and it is, but when investor sentiment gets extremely positive, and these are based on many different measures that we have, it often points to a period where the bull market is actually coming to an end. The other thing that we look at is within the S&P 500, how are the 500 or so stocks within the index performing relative to what the average performance or the performance of the actual index was just shown here? Are a lot of stocks within the index moving up, or is it just a small number of them? When a lot of stocks are moving up along with the S&P 500 index, that's a positive sign. That's a sign that the bull market likely has further to run. That's been the case recently. If we were to see a much smaller number of stocks doing the heavy lifting, meaning only a small portion of the big stocks are moving up and many, many stocks are not, that would be a signal that the bull market could be coming to an end. We're not yet seeing that. The other trigger to an end of a bull market tends to be a recession. So when recession risks rise, when fears go up that a recession could happen, bull markets usually come to an end. And I just showed you the economic estimates. We don't have that case right now. But of course, we have to monitor all of these things because these things can change. Now, if we go to the next slide, what I'm showing you here is earnings growth of the S&P 500 each quarter. So, for example, how might we grow this quarter compared to the same quarter a year ago? That's how I'm showing you. The thing to focus on here is the fact that it is not only economic growth that is very important for the market, it's also earnings growth or profits, because when we're investing in stocks, what we're buying is a portion of those profits. And it's those profits that drive the market over the long term. Generally, when profits go up, the markets tend to rise. When profits come down, the markets have a tougher time and you get a bear market. So what this is showing you, again, past in dark blue and projections of all of Wall Street analysts put together, projections in light blue. And what it shows is the projections are for profit growth, earnings growth to continue this year, which is a good sign. Now, you can see at the top there, I have earnings growth is expected, but forecasts may be too rosy. These are just forecasts, and they can change. And when I look at those forecasts for the third quarter and fourth quarter of 2025, those two light blue bars that you see at the very end, those look pretty optimistic to me. If we were to get the 2.6% GDP growth that we're talking about, I think those are probably a little too high. If GDP growth ends up being under 2% or even lower, then those forecasts probably would be much too high. So this is something we keep in mind when we're considering how much of equities to own in portfolios and where exactly to own equities, at what levels, and which indexes do we focus on, which funds do we focus on, which sectors do we focus on. We're keeping these estimates in mind. So the good news is we expect earnings growth. However, we need to be a little cautious because the projections for the end of the year look like they're probably too optimistic. Now for the next slide, what I'm showing you are price to earnings ratios. If you're familiar with the stock market, you may be familiar with these. These are figures that we use to determine how cheap or how expensive is the stock market. Because quite frankly, the stock market is like any other good. It can be too expensive or it can be cheap, on sale at any given time. And where things stand with the stock market right now is it's rather expensive. It's pricey. So I'm showing you two different measures here. One shows actual earnings that have taken place in the past, and the other shows based on projections, okay? And the only reason I'm showing you this is because these are two of the common ways people like to examine whether the market is cheap or expensive. And either way you slice it, whether you look at it on prior earnings or forecasted earnings, the market looks pricey. And we can tell by that each of those lines are above a standard deviation dotted line. So I don't want to get too much into the weeds for this. The main message though here is this is another thing that keeps us vigilant about the stock market and somewhat circumspect about the potential for the market right now, because it is pricey and we need to keep that in mind. But I will tell you quite frankly that whether the market is cheap or expensive is not what we call a good timing mechanism, meaning we don't make decisions to buy or sell depending on whether a market is cheap or expensive. And the reason is because the market can stay expensive for a lot longer than might seem rational. It can stay expensive for years and keep going up, in fact. And the market can be cheap for a lot longer than might seem rational. So for long-term investors, this is a nice gauge to be aware of, but it's not something that should drive our decisions. On the next slide, I want to talk a little bit about fixed income. Obviously, a very important component of long-term portfolios. Right now, what we like to focus on are quality opportunities within fixed income. And what I mean by that is Treasury bonds finally offer some meaningful income. That's been a good thing. Investment grade corporate bonds, they are expensive right now, but for buy and hold investors, for long-term investors, you can earn some marginal cash from investment grade corporate bonds. When it comes to high yield bonds, those are the parts of corporate bonds that are more risky. They have lower credit ratings. We actually think those look very expensive, and we would prefer owning quality equities rather than having large portions of high yield debt in portfolios right now. But of course, most balanced portfolios have some exposure to this and should. High quality municipal bonds are attractive if that makes sense from a tax standpoint for investors. Now, on to the next slide. The big question that a lot of investors have right now is, do the election results change the outlook? And how should I be thinking about this in light of portfolio positioning? And I will say that Washington certainly influences what happens in the economy, and it can influence what happens with investments and with markets, but it does not control the domestic economy. Washington can't flip a switch and say, well, the economy is growing at a certain level, I'm going to amp up growth by 2 full percentage points. That doesn't work. We have an extremely large private sector economy in this country. And the natural ebb and flow of the economy, also Federal Reserve policy, also innovation, tends to matter more over time than decisions in Washington. Furthermore, we still have checks and balances. And I know that during the campaign, there was talk about the breakdown of the checks and balances in our system, but we still do have them. We have the judiciary branch. We have many different layers within the judiciary branch, both federal and state. It's not just the Supreme Court that's going to be deciding things. The bulk of cases will be handled within district courts, appeals courts at the federal level. So my contention is checks and balances are still there and they still matter. But regardless of the fact that overall, throughout history, Washington has not played the biggest role in stock market or bond market returns, there is no doubt in my mind that markets will pay closer attention to Washington policy this year than they have in recent years. And in fact, policy can and probably will generate volatility. And we're starting to see that right now with the recent news that's been released related to tariffs. Let me move to the next slide because it discusses a bit about President Trump's economic agenda. There are a few pillars to this agenda. First of all, he wants to extend low tax rates for individuals. So those were the tax rates that were put in place from the Tax Cuts and Jobs Act that was compiled in 2017 and enacted in early 2018. That lowered taxes on a host of provisions for individuals. It also lowered taxes for corporations. And you can see on the chart there on the left exactly what happened from a corporate tax rate perspective. Before those tax rates were put in place, the median effective tax rate, so the average tax rate that an S&P 500 company paid, was 30.5%. After the corporate tax rates were implemented, that average has hovered around just shy of 20%. Now, we all know that there's the actual rate called the statutory rate that comes out. Companies end up paying a different rate than that. So this median rate is just that, it's a median. And I think we all know that some companies pay far less taxes. So we can debate on whether or not a low corporate tax rate is good or bad for society, and there may be very different views about that. But when it comes to the stock market, when it comes to the S&P 500 and the other major US indexes, the stock market always prefers lower tax rates. And in fact, we did see a boost in the market after this was passed. So the interesting thing about the tax bill that was passed when Trump was in his first administration, it's set to expire. Many of the provisions, those related to individuals, are set to expire at the end of this year. So if nothing's done, taxes would increase. And he would like to take that same tax package and extend it, basically extend it for a number of years. So keep tax rates low for individuals. The corporate tax rate does not automatically sunset. So that low corporate tax rate will stay in place. President Trump would like to potentially lower tax rates further for domestic goods producers. So if a manufacturer is producing here in the United States, cut the tax rate further to 15%. So these are two key provisions that the market is focused on. Extend the low tax rates for individuals and keep tax rates low for corporations and potentially lower them further. These are what we call pro-growth items. The thinking behind this is it could help economic growth. Economists debate that, whether or not it's true, but the stock market's perspective is to basically have a positive view on these two provisions. Now, there are some other provisions that are part of Trump's economic agenda as well. The third that I'm showing you here on that bullet is to increase tariffs, to raise revenue, and also to reindustrialize the US economy. Inflation risks do come with this. We had the president announce that he would be putting in place significant tariffs on Mexico and Canada, 25% tariffs on all Mexican goods, 25% tariffs on Canadian goods, with the exception of energy, would be a lower tariff of 10%. And he also announced a 10% tariff hike on Chinese goods. All of these rates would come above what are already currently in place. Now, these are not implemented. The initial news is that they would be implemented Tuesday morning. I just saw a headline a half hour ago that Mexico was saying they would be put off for a month. Regardless, the thing to consider when it comes to tariffs and the stock market and financial markets in general is that this negotiation and these tariff announcements and then perhaps counter announcements by countries has the potential to create volatility for the market. It injects a lot of uncertainty, not only into the market, but into the economy. So it affects thinking about what is the inflationary impact? Will there be a hit to economic growth? There are many different implications, and this process is very fluid. So even with the announcements that occurred over the weekend, we don't have certainty that those are going to be followed through tomorrow, as was originally stated. So there's a lot up in the air regarding tariffs. And we are very focused on this. Many different analysts, economists, oil market specialists, natural gas specialists, currency specialists, those of us who specialize in the stock market, those who specialize in the bond market, have all been very focused on this over the weekend. We will continue to be focused on this issue, not just as it pertains to our neighbor Canada and Mexico, but as it pertains to China, as it pertains to the European Union, and as it pertains to sectors and industries that might see tariffs implemented on them as well. So there is a lot to consider, and this could create volatility. President Trump also wants to deregulate significantly. There are some potential obstacles as far as this is concerned, because there are forces within the different government agencies that might have the potential to weigh in on this. And there are also some potential court challenges. So we'll see if that happens. So these are all the things we're considering with the economic agenda of President Trump. Some considered pro-growth, some considered to be potential risks for markets. In the interest of time, I'm going to move along a little bit more quickly here. President Trump has spoken a lot about foreign policy, and during the campaign, I think there was a misconception that foreign policy was going to be very inward focused, that the United States was not going to be engaging a lot with allies and with other countries and would not necessarily have an aggressive foreign policy. I would say that was a misconception. And indeed, we're already seeing from the actions that the administration is taking that foreign policy will be very active and assertive regarding rivals, competitors, friends, and allies, and that foreign policy will remain quite hawkish. Let me sum it up here. So the bottom line for 2025, we recommend being nimble in portfolios due to complexities. That means when the market gives opportunities, taking those opportunities and being nimble with the focus on sectors and industries. We anticipate there is scope for mid to high single-digit returns in equities, but I will say that these policy issues could not only create volatility, but could create some pullbacks. A 5 or 10% pullback in the market at some point this year, if not a couple of times this year, would not be surprising at all. And in fact, that is more of what we expect to happen. When it comes to fixed income, as I've said, focus on quality, expect volatility. We do expect the economy will deliver above 2% growth, and that inflation will stay a little bit higher than the powers that be would like this year. So why don't I wrap it up there and see if you have any questions.
Thanks, Kelly.
Any other good news? It's what it sounds like this year may not be as good as '24, right?
Yeah, there's, you know, at the beginning of every year, I say to myself, this is going to be a hard year to guess at. 2025 is going to be an especially hard year to guess at, but I think if I had to make a guess, I would guess we're not looking at the kind of thing we got in 2023 and 2024. I would guess that from a bond standpoint, we'll probably come out roughly even, which means you'll make the yield, but you won't make more than the yield on bonds. On the stock standpoint, I think if things work well, we're looking at half the return of last year on bonds, on stocks, which, you know, 12% is higher than the 50-year average. So it's still not bad. It's just not what we've seen the last 2 years.
And what's your view on interest rates? Do you have any on that?
Well, I think
that
Kelly covered some of that, and for the most part, you know, I'm in agreement. I think where the Fed is concerned, setting short-term rates, you know, you have dual forces. You have the White House kind of pressing them down, and the economy kind of saying, hold the line. My guess is that this year, either they will be holding the line or coming down slightly on short-term rates. Where you're talking about 10-year rates, that's more controlled by the market. And my guess is the sweet spot for where that will be is between 4.5 and 4.75. For the 10-year rate, it's about 4.5 right now. But it could be a little bit higher than that as well. So, you know, that would be my guess on what's going on. Where earnings in the stock market are concerned, I think Kelly did a great job of outlining their pros and cons, as there always are. One of the things that I think is worth bearing in mind where it comes to earnings is earnings are not a real part, quote unquote, real part of the economy. In other words, they depend not only on how the economy grows, but also on what inflation does. So if the combination of the growth in the economy plus inflation is 5%, then that's kind of your baseline for earnings. And typically what we've seen in the past is earnings recently have been increasing at about double the rate of nominal GDP. So if nominal GDP is rising at 5% this year, maybe earnings come in the high single digits, you know, which from the standpoint of the stock market is kind of supportive. You know, Kelly made the point that the stock market is expensive now. So, you know, what the stock market is probably going to do is trade off, well, you know, on the one hand, tax rates are going to come down and earnings are looking pretty good. On the other hand, we don't have a clue what's going to happen with tariffs. So there's risk there. We don't have a clue what's going to happen with Ukraine, which may have some impact, certainly where Europe is concerned as well. You know, in other things we don't know. I mean, if I looked at risks, and I think these are low probability risks, but they're not zero probability risks. You still have commercial real estate, which is kind of an issue right now. You still have private lending, which hasn't blown up, doesn't show signs of blowing up yet, but could blow up. And I think both of those are low probability events, but they're not zero probability events. So, you know, it cuts both ways. And the result of that is, to Kelly's point, you may get earnings increase okay, but because people are worried about the environment, they bid down the price earnings ratio. So the result is that when you look at the stock market, earnings are up 10%, and maybe the stock market's up 6% or 7%, something like that. But I think those are the kinds of figures we're probably looking at for this year.
Any questions?
Yeah, I have a question. So The price to earnings ratio being high, is that a function of how much of the stock market is information technology? Like, does that tends to
Yeah.
track higher
It tends to track
for
higher.
that
That's
sector
exactly
than
right.
others?
Yeah, that's exactly right.
Okay, and then,
And by the way, their earnings growth the last 2 years has been pretty good. Something that people tend to forget is in 2022, the stock market was down 20%, IT was down 40%.
okay. And then secondly, I just would ask, our policy for guardrails basically on percentages of equity versus bonds, it sounds like you're anticipating fairly nominal bond returns, so it wouldn't help to be more flexible in terms of how much we could
That-
allow for bonds, right?
Exactly right, and
Okay.
that's the balancing act.
Right.
That, you could say, well, if you're worried about the stock market, why don't you put a bunch of money in bonds? Well, if bonds are paying 4.5% and the pension fund's bogey is 7%, if you put a bunch of money in bonds, you're guaranteed to underperform your bogey, right? Even if the money's safe. So it's a balancing act.
So, I mean, going forward then, the best you can do is be vigilant and try to do the best you can in equities is kind of
Exactly.
what you're saying, yeah.
Yeah, and to Kelly's point, be nimble. That's what I think this year is gonna be about.
Thank you.
Is our percent 7 or 7.25?
It's 7 now. Yeah. Yeah, it's come down a little bit.
The board did that?
Yeah.
Well, that's good.
Yes.
All right?
Yeah, in general, what the pension board here has done has been conservative in terms of its management. And I think, that plus having a good stock market has really been beneficial to the health of the pension plan.
Yes, and I'm glad that it's at 57 million. I hope it stays there. But if you remember, we periodically did stipends for the
Yes.
current retirees because they
Yes.
don't have any automatic increase in their
Right.
pension. And the last time we did it was a very good year that we had, so hopefully that's something I'd like to get involved in again
Yes.
here, but
Yep.
we have other things right now that we're dealing
Yep.
with. So.
And as you remember, when that happened, we did a number of studies internally about what the cost would be and the
Right.
benefits and all that. Happy to do it again.
You might be asking for
Yep.
that. Yeah.
Yep.
Okay. We have another presentation?
Nope,
Oh, that was it?
that's it. Yeah,
Oh.
Yeah.
I thought it was one more person.
Nope.
Okay.
that's what we've got for you today.
Well, you did a great job. Great report. Thank you. Okay, we'll go to period for public comment. There's no public here, really. Items by trustees. Any questions by the trustees or discussion on anything?
No, just that I'm pleased to continue to see the good performance of our fund.
Yes.
I think it's been well managed and, so that's good to see. The outlook going forward is a little concerning, but, we'll just take it as we come. It can't all be good years. Some have to be down years or
Yep.
level years, so.
Okay. Joanne, did you have anything? I know you got here.
No, my
Okay. All right.
calendar was set for 11.
No, it was changed last month to 10:30.
Oh, it didn't get changed in my Outlook.
Oh. Anyways, anything else before we adjourn? There's a motion to adjourn.
So move.
Terry, second.
I second.
No, all those in favor say aye. Opposed?
Aye.
And the motion is adopted.